So hi everyone, thank you so much for joining in. This is Roop, founder of 256 Network. So I'll just take 5 minutes to talk about what the network is all about. Most of the guys knows about it because they're a member of the club, but still we have some 3, 4 friends of ours from US. So just to give a sense of it, what we've been trying to do from past 3 years. So this is started in 2018 as a small group of investors interested in investing in Indian alternative investment space. Over the last 3 years, we have gone global with some close to 556 odd members representing 300 plus asset management firms globally. Currently, we are one of the, I would say, I can say that one of the world's largest GPLP club, private club. Our members are not only MDs and GPs of every major VCP in Southeast Asia, but also managers across asset classes like public markets, debt, commodities, and even art. So our members are also mostly international and come from 24 odd countries. Cumulatively, most of it's sort of a market AUM. Our member firms manage over $3.9 trillion in assets. We are extremely selective about our members, and all our events are closed door. The aim of 256 is to bring a sense of belonging and trust to asset management bridge, the trust deficit existing today. So we are happy to announce why we are here today is to launch of 256 EFM. This is a global network of first-time forensic fund managers. The primary objective here is to use the patronage of a larger investments community to support the fund managers' core focus around capable selection and deployment. This is in line with the 256 North Star of frictionless engagement for a peer group of the most influential, informed, impactful, and innovative leaders globally. So this is like one of our first episodes and more of a launch of our EFM club. We begin with a series of sessions to decrypt challenges of getting things off the ground. And in this stellar first session, we have mix of global EFMs and LPs to discuss thesis selection, LP constructs, and mean value creation. So I'll just quickly introduce our panelists. We have Mark Linau from Progression Fund, Anjali Bansal from Moana Capital, Chirantan Patnaik from 3C Group, Yohei Nakajima from Untapped Capital, Stasi Amretsky from Ria Ventures, Yash Chen from Sparrow Capital, Jessica Kerr from Fiore Ventures, Dipankar Panigrahi from OIA, Pearl Agarwal from Exenius Ventures, and Adit Poddar from Gemba Capital. I'll hand it over to Akash and Yash, my colleagues, who would be moderating this session with us for next 1.5 hours. So over to you, Akash and Yash.
Okay, guys. So wonderful to have everybody here. This is, like Dhruv mentioned, a new initiative of ours, specifically geared towards emerging fund managers, first-time fund managers, and helping them tackle the various challenges that established industry veterans have faced over the years to build their own brand, build their own reputation, grow and support the larger startup ecosystem, which is essentially the end goal for everybody in this industry. To that end, given the fact that the ecosystem is maturing very quickly with individual fund managers going after very unique propositions that they are sort of bringing to the table, it's sort of difficult for a lot of the other ecosystem stakeholders to fully understand and grasp the intricacies with which to approach these fund managers and also to work with them. Through a series of sessions, we aim to try to illuminate these intricacies, but also work in a more structured manner in terms of helping these fund managers in whatever they feel would optimally help them grow and become more useful, sort of catalyst for the larger ecosystem itself. Be it with respect to looking beyond just investments and thinking about LP structuring, follow-on fundraisers, thinking about marketing and core functions, that are intrinsic to larger VC funds, which may not have been well established or well adapted within a smaller industry framework, while also taking advantages of the lean and mean sort of team that comes together to execute and move swiftly with the kind of structuring that is put together. So trying to capitalize on the learnings of the ecosystem for everybody involved, while trying to bring the right kind of visibility in terms of the dynamics of working with EFMs for both startups and limited partners. That's the large initiative across these next set of episodes that we'll be partaking in. And to begin with, we've sort of put together a pretty stellar set of crew in terms of LPs, like individual VCs who have, for example, Anjali, who's come on board, who's participated in in supporting many fund managers herself, but also at an organizational level, she's built up several different organizations at leadership positions and has like a wealth of knowledge to disperse. Deepak comes in from his work at OIA and the kind of institutional mindset that needs to be sort of understood by emerging fund managers towards sort of adopting the right kind of frameworks and building up towards the right kind of frameworks internally to potentially raise capital from institutions such as himself. So wealth of knowledge there as well. And lastly, Chirantan from CDC. CDC is one of the largest allocators as an LP towards AIFs globally, more so in India as well. But the objective is to get his perspective from a DFI angle as well, in terms of what degree of participation can emerging fund managers perceive and at what stages, and how to work up towards building the right competencies to be able to attract that capital. So that's the kind of LP pool that we have, just on the panel itself. We have a whole bunch of LPs who have signed up to listen to this or, listen to this, post this conversation as well. That's one of the reasons why we're recording this, because the timings don't really always work out for the best. It's, as you guys all know, Sunday night, India time. So it's a little difficult to coordinate, but we wanted to record this and put this out so that the larger ecosystem can benefit from this as well. Beyond that LP crop, we also have, getting widespread industry knowledge and expertise from folks who are building their first, venture capital funds themselves. And I'll let Akash, if you're back, introduce the rest of the crew.
Hey, thanks, Yash. I hope my Wi-Fi is a little more stable now. We've got fantastic. That's great. So we've got a great crop of LPs here with us in the room today, and we've also got an amazing group of people from the US joining us. Let me introduce all of them to everybody here. We've got Progression Fund, an LA-based fund founded by Musical.ly and TikTok alumni, and they invest alongside generational teams from Gen Alpha, Gen Z, Millennials onwards, and follow that behavior as it evolves over time. The fund today is represented by one of the partners, Mark Renau. He was also a partner previously at AET Fund. We've got Ria Ventures next, an impact-focused fund based in San Francisco, investing in women's reproductive, maternal, and sexual health. They make all their investments here in the United States. The fund today is represented by Managing Director Stasia Obrimsky, who brings 25 years of consulting and investment banking experience to venture capital, having been at Bain Consulting and Morgan Stanley. We've then got Yohei Nakajima from Untapped Capital. Yohei was also my previous colleague at Scrum Ventures. Untapped is a Seattle-based fund investing in under-networked founders, sourced primarily through outbound. He was previously, as I mentioned, a venture partner at Scrum Ventures and also the director of pipeline at Techstars. Lastly, we've got Coyote Ventures, an SF-based fund investing in women's health and wellness. The fund today is represented by Jessica Carr, a scientist turned entrepreneur turned investor, who previously led R&D at Impossible Foods. So I'm really, really excited about the crop of investors that we have here joining us to listen to all of our emerging fund managers from across the globe. And I'm really, really stoked about the conversation that's going to unfold over the course of the next 90 minutes or so. Yash, do you want to kickstart the conversation?
Yes, absolutely. We also have Yash Jain from Sparrow Ventures, a fund that sort of is a benchmark within the emerging fund managers crop from India. And they've been doing exceptionally well. They're looking to raise their second fund now. So technically EFM, not EFM, but that's the pace at which this industry moves. And Yash has been doing stellar work with his LPs, who've been very happy with his performance as well. But in terms of his past background as well, I think he's coming from Kalari Capital and Arkham Ventures as well. And he's done a bunch of interesting work there, and look forward to hosting him. We also have Adit Podar from Gemba Capital. Again, a stellar fund with an amazing reputation among founders here in India, and somebody who's looking to take the pedigree of investing really early, very quickly, very briskly, but efficiently taking that forward. Lastly, we have Pearl Agarwal from Eximius, And Pearl joins us with a focus on certain few specific areas, and we'll jump into that very quickly because that's the first point of our conversation. But Pearl, she's like some interesting conversations have been propping up, and Eximus is leading that charge in terms of how to attract the right kind of deal flow and also help the right kind of companies. And in terms of beyond reputation, right? Like looking beyond reputation and specifically working towards the right kind of event strategies, working with the right kind of ecosystem penetration work that really helps you gain the right kind of advantages to attracting the right kind of talent. So Pearl joins us from Eximus, and that's largely the panel that we have today. So Akash and Dhruv, so we've sort of lined together 3 interesting conversation points. Eventually we'll move towards just 1 interesting conversation points because we had such a large panel today. We want to make sure that we get different perspectives from people. So the first point of conversation, and this is something that during the introductions a lot of you might have already noticed, is that there are a lot of these funds who are starting up who have very specific themes or theses that they've selected, be it demographic focused, be it geography focused, be it a niche industry focus as well, right? This is most likely, contributed towards by various factors, various parameters coming together and building a case for why that theme makes sense, why the team executing on that particular theme makes even more sense, and largely why the founders resonate to that combination, right? So starting off with Pearl, because you've had that experience of just starting off and working on the gaming space, starting off with a wonderful event that just got wrapped up very recently. So Pearl, what are your thoughts on how that thesis was really built for you?
No, absolutely. I think one of the things that we are doing is while we are not focused on just one sector, we are making sure that we are focused on just 2 or 3 sectors rather than sort of going sector agnostic. And where this view is coming from is we believe that India is a deep enough market right now to focus on a few handful of sectors where we can really build expertise, whether it is expertise from a thesis perspective, figuring out where are the white spaces, or identifying the right sort of advisors and experts who can come in and help us. But at the same time, we're still not there where we can only focus on one sector per se. So the 3 sectors that we have identified right now are fintech, gaming, and health tech. And in gaming is the first one that we are focusing on. Gaming, we recently did a couple day of event where we sort of had everybody from Nitish Mittersain to Rajan Navani, all the leading gaming thought leaders from across the world come and speak. And the idea for us was to do 2 things. One is to sort of have a set of advisors that we can work with on an ongoing basis to really help us shape where the industry is evolving and be at the forefront of it. And also with the help of these advisors, bring in that value to the founders where we are investing beyond what our team can provide. And then the second one definitely was to sort of build a thesis further, where you can listen to industry stalwarts and learn from their thought processes. And we've started with gaming, but the idea is that going forward we'll be doing it with health tech as well as fintech, and try to build a thesis in that space. Another thing in this thesis building that we're sort of focusing on is trying to see what is the depth in the market to eventually start to evolve into a more dedicated fund. So the first one is with gaming again, where we've launched a syndicate that allows us to be a little more flexible with our thesis and the kind of checks that we write to really sort of test, what is the depth in the gaming market. And if that goes well, then, eventually sort of evolve into more sector specific funds as well. So that's how we're approaching it.
Understood. Thanks. Like from an operational perspective, I think you guys are doing a wonderful job of hitting the nail on the head in terms of the work that you're doing for the 3 sectors that you're targeting. I want to lead this conversation to 2 of our funds here who are specifically working on a demographic plus healthcare sort of focus coming together, but one more so from a consumer perspective and one more so from the B2B and the more research perspective as well. So we have Stasia from Ria Ventures and we have Jessica from Coyote Ventures, who've sort of both evolved similar themes to a certain extent, but approaching it from very different perspectives. And, taking that thought process and sort of evolving that into understanding why you guys firmly believed what you did and why it led you in the directions that it did for the spaces that you've gone after, which is femtech. So if I may, if Stasia could start us off and give us an indication or an understanding of how that entire piece evolved for you, would be very helpful.
Sure. Thank you. And good morning, everyone, or good evening. Yes. So I think, the thing I am sitting here listening to is like, what is the definition of emerging? And I think each of us may have a different tilt on that. But, at RIA, we feel like femtech is an emerging investment area, which we've seen tremendous amount of company formation and tremendous amount of capital come into the space over the last 3 to 4 years. And so in one sense, emerging for us means we're beginning to invest in this emerging investment area. And, while I'd like to think that, women make up half the population and we birth 100% of the population, that our health should matter. And you sort of wonder, why has it taken this long for women's health to become, a focused area of investment? But it has been considered for many years to be, quote, a niche, which again doesn't quite align with the demographic facts. So at RIA, we are very focused within women's health, looking at reproductive health opportunities. And again, if you look within women's health, reproductive health has even been more underinvested in, and we think has many more unmet needs than certain other areas of women's health, which also suffer from those things. But as an emerging fund, we have chosen to take a very deep expertise in a vertical, and that has been in women's reproductive health. As a result of that, we invest across all segments of the healthcare system. So we do biotech, device, diagnostic, IT, health service, and because we have such a deep knowledge in the vertical, we feel confident that we can amass the expertise and the technical diligence we need across all the different segments. So again, emerging for us means an emerging vertical. Second, it means a all women-led team, and while we are not, some of us are not first-time investors what does that really mean? It means from an institutional definition, we are first-time investors because either our personal or impact portfolios or our previous venture experience, because it wasn't necessarily funded by institutional investors, doesn't really count in terms of their definition of what is established versus emerging. So again, the themes that emerging to us means a subject area, fund managers which don't meet the definition of institutional, managers, and then, a diverse team. And I know a lot of LPs are looking for sort of gender diversity and geographic diversity as they look at their alternative asset allocations over time. So those would be my perspectives.
Perfect. Thank you for that, Stasia. Just like a quick follow-up question to that. What is your perspective on the business aspects of running a venture capital fund, which is specifically focused on a particular thesis? How do you think about it purely from, let's say, a venture and a strategic venture capital model?
Well, in some ways, it's a lot easier, right? Because so much of venture is what do you say no to and what do you say yes. We have a very specific screen, both around impact, what communities are being impacted by this investment, and secondly, what is the investment area. So in some ways, I think it makes our job easier because we can be very focused, ruthlessly focused. And the first screen we do when we look at a company is, does it meet our impact criteria and does it meet our investment strategy? And if the answer to those 2 questions is no, then we move on to other opportunities. So from organizing, and again, it helps prioritize which conferences do we go to, which networks do we tap into, what expertise do we need to bring in. So it's very clarifying in a way to have such a focused area of investment.
Absolutely. Thank you, Stacia, for that. Jessica, similar sort of vertical that you're going after, an emerging vertical. But are you looking at it differently from, let's say, Stasia here, like from a demographic perspective, from the tailwinds that you're approaching this with, like what do you think? How are you reading this specific market? And do you think it's slightly different from either X, Y, Z, anybody else, either like a solo venture capitalist or like an emerging fund manager or a more, advanced fund manager with like multiple different thesis areas? They might be looking at it differently. Like what do you think you have in terms of proprietary intelligence, information, or just frameworks towards investing in this space that you think sort of differentiates you from the rest?
Yeah, and good morning, good to see all y'all. And I'm very collaborative with Stasia and Stasia at Ria Ventures. And of course, our thesis is a little different. We're both looking at women's health. We're looking not specifically just at reproductive health. So it is broadened a little bit, but we're looking a little less at the highly regulated areas. So a few of our first investments are more in the consumer space. And so I think coming at it from my background at Impossible, where it was biotech meets consumer, is a good way to look at women's health. There are very science-based solutions for things that have a very massive positive impact on women's lives. And so I think us having like definitely like a science lens and an impact lens is one way that we're definitely assessing our deals. And going back to what Stasia said just about it being an emerging market, this was definitely where Impossible Foods and alternative protein was about 10 years ago. So just being really data driven, where do we see a lot of the innovation and where is there a lack of innovation? That's where we tend to go. So there's a lot of areas of women's health that basically like might affect 1 in 4 women, but there might only be one startup we've seen so far. So we definitely get really excited about some of these areas where there really hasn't been anybody pioneering in the space before. And so definitely just bringing some of that like scientific rigor and some of that experience of like not launching something novel that hasn't really existed in the world before.
Perfect.
Should I explain Impossible Foods, or does people in India pretty familiar with it?
Yes, absolutely. It's hitting and a lot.
Okay. I wasn't sure the global audience. Basically, it's a alternative meat, but it's very science focused. Yeah. And so that being my background.
Indians have grown up on veggie burgers, and this is probably one of the best tasting veggie burgers I've ever had.
Thank you.
The Impossible Burger. So yes.
Kudos to that. Just taking a poll here as opposed to a question. So between Dipankar, Chirantan, and Anjali, are you guys familiar with ARK Invest, the theme-based, vertical-focused ETF investment platform, which is accessible to a lot of folks in the US, but globally as well? Are you guys familiar with that? Right, like all of you
yes.
are. Wonderful. So how do you guys draw parallels between what's happening there in a more evolved public market space with thesis-driven investing, which is specifically targeting and tackling one particular theme, right? And going after it from an institutional investor or a family office perspective, investing in and trying to capture tremendous value through a portfolio approach, but in the private markets there versus the public markets there versus the private markets here that we're talking about. And any thoughts on that? Open to all three of you all.
Well, first of all, thank you, Yash and Dhruv and the 256 team for having me here and also for arranging this. This is a great opportunity. Second, I think I have to give this disclaimer that whatever I say is my own view and not that of the organization. So once I get that out of the way, I'll start talking. I think from my own perspective and my own experience, both here and in other organizations that I've worked for, I think sector specialization does help. I think given the interest, I think the only risk I see with some of the over specialization, if you're doing health tech, it kind of makes sense. But as an institutional investor, it becomes very hard to say, well, we will deep down, especially outside the US. Maybe in the US, you have funds where they have specializations. But outside the US, given the vertical portfolio allocation is slightly different, right? You allocate in healthcare, you allocate in financial services, this and that. There to go deep down and say, well, we will do something very specialized can be more limited in scope, at least my own experience. That said, I think if you are very specialized and you have a very strong thesis, you have the opportunity to work, especially as an emerging fund, with more strategic investors, people in the corporate sector, people who are looking to expand, and they might not only add capital, but they might also help you expand into certain other geographies where you may not have access to. And that's probably a value add you need to consider versus an institutional investor, which, irrespective of our size, sometimes cannot actually add any real incremental value in terms of strategic value add.
Got it. Chirantan, any thoughts on this?
Sure. I'm so glad I read an article on ARC this morning to sound a bit intelligent. But I've been following the model. A couple of my friends are in hedge funds, and they have a much better perspective on that, tracking global markets. I think what ARC is doing is it's going at the end, right? It's taking a higher risk at a later stage. It's interesting but bold strategy. So I do like the thematic approach, the whole, focusing on technology disruption. But I think for them, managing risk is harder. And as you can see in some of the results right now, it's not doing so well. That's why I always consider, and maybe I'm biased on venture capital, that the early stage private market model, the risk mitigation kind of guardrails are already inbuilt. You have a stage by stage investment approach. If things are not going well, you can always kind of pare your investment down or write it off, and it's fine. It doesn't really blow up anything. But I think with this particular model, you're exposing so much of your capital. It has some something to blow up. So I'm just on the fence of how that's going to play out in a bear market, which I'm pretty sure we will approach in some point of time. Having said that, I think this has been the longest bull market, some 15, 20 years of tech. But glad to see it's going well. I do also understand, I think Tesla is the only stock which is pulling up everything. So you can almost say that's a VC winner takes all model coming into play.
Interesting. Very interesting thoughts there. Anjali, similar sort of question, but you play two hats, and I'd love to get perspective from both those hats, right? Like you run a large fund with multiple different theses, thesis agnostic to a certain extent, to allow you to be able to go after spaces which are just evolving, go after femtech, go after gaming, go after anything that you might be interested in, right? But at the same time, also have the perspective of running a large institutional model of raising a fund, from LPs, sort of liaisoning with them to be able to build them up towards your next fund, your follow-on fund, so on and so forth, and working towards it as an operator as well, right? So what are your perspectives on going after a very steady thesis focus? I'm sure like a lot of funds have internal thesis focus teams, right? Is that something that does not sort of counteract the kind of efficiency that some of these funds are able to bring out to the forefront? What are your thoughts on it from an operator and an LP?
Great question, Yash. Let me start first as an LP, really. And I think it dovetails quite neatly into our approach as a GP as well. So I think it's important to stick to your knitting and hence define what your knitting is. So the knitting, and it could be anything. It could be to say, I will only do fintech, or I will only do femtech, or I will only do gaming. The only caveat here is depending on the market that you're playing in, and it could be a geographic market, it could be an economic market, there has this, whichever space one defines as a fund manager, there has to be enough opportunity there. So there is a balance between having knowledge and expertise. And I think Stasia said it so well, that so much of being a good investor is knowing what to say no to and filtering that out early. And that is one of the things we look for, and we are partnering. We're very, very happy to partner with Yash and Akash at Sparrow, and big supporters of theirs, big fans of how they're actually building it with discipline. So there is discipline in what areas they will focus on and what they will not, but at the same time, it is broad enough to give them enough opportunity for portfolio construction. So hence the balance between defining areas of expertise. If you're in a large market like the US, then it is easier to be sector focused. In India, I think some of the sectors, let's leave out health and financial services, and I will say fintech, health tech are very broad and large areas. So you could actually be a focused fund, but otherwise it's important for portfolio construction Also to catch trends at the very early stage for micro VCs, it's important to catch trends and hence keeping the flexibility in your sector definition and sector focus. Ultimately, it's about having access to great deal flow and being able to make well-informed choices when you make investments. So that's kind of with the LP hat on. We take a similar approach as a GP. As a GP, our focus is we look at areas of technology-led innovation. We could call it disruption, but frankly, disruption, innovation, two sides of the same coin. I'm a positive thinker, so I choose to think of it as innovation. So technology-led innovation that can lead to outsized returns, but also create impact at scale. We have chosen to define impact in a sharper way with an even clearer lens now on climate and sustainability as a GP. But in that space, so that's kind of our focus area. In that space, we look at food systems, so food and agri. We look at mobility and supply chains, financing mechanisms, so that's risk, investment, including protection, insurance, credit, and so on. As well as being able to then go into digital tools and enablers. So again, keeping India as a market, and again, all of this is market specific. So if you are in India, then keeping adequate flexibility that you're able to catch trends and get to great investment opportunities, at the same time having a thesis so that you can build expertise and be able to underwrite well. So I think we take a similar approach whether we are an LP or a GP.
Understood. That's very helpful. We've got LP perspectives, slightly positive, slightly negative, somewhere in between as well. Just want to ask the rest of the EFM crew if they have any sort of counters or any sort of questions around this particular space as well. I know you guys don't all have very sector specific themes that you guys are working with, but if you do, and if you had thoughts to contribute to this, always open to hearing from you guys as well.
Yeah, I actually want to bring in Yoe and Mark here because both of them are really building funds in an interesting demographic. While Mark is investing in generational themes and Yoe with under network founders. How do you stumble upon this particular thesis, the two of you? Because one of the reasons I ask this question is I have conversation with LPs, and many of them are first-time LPs themselves. And their question back to me is, how are fund managers thinking today about developing their own thesis, especially given how competitive the micro VC space is right now? So when you're putting together your own internal thinking before you launch the fund, before you head down and start fundraising, how are you approaching this, and how do you then construct your LP base, keeping your thesis in mind?
I can touch on that quickly. I think either from a GP or LP perspective, you want to think about kind of the ecosystem as a whole. And the ecosystem, you want both generalists and specialists. Specialists can get to know an industry really well, understand it, bring the industry together and support these companies to grow. But generalists are able to find new industries that maybe a thematic fund hasn't explored in. So they're really able to look for things that maybe thematic, that don't fit into any thematic funds. And from an ecosystem perspective, you want both. And then from our perspective, we were looking at the ecosystem and felt like a lot of the specialties were focused around industries and not around the operational kind of piece of VC. So we looked at, most venture funds, sourcing through referrals, and having experience in doing a lot of kind of outbound sourcing. We thought we should look into doing a fund that primarily sources through outbound, where we're reaching out to founders and talk about it loudly and see if that's an impact we can have on the ecosystem as a whole.
I guess I can add, talk about a little bit how we looked at forming our thesis and how that translated into the verticals that we actually have been focusing on. At Progression, we're pretty focused on next generation consumer. And we think like three things kind of drive that. We call it with three variables really: generational differences, technology adoption, and historical events. So I guess for generational differences, the examples of like some category defining companies in consumer social was Facebook going to Snap, and then Gen Z is now TikTok, right? For technology adoption, we look at it like, okay, there's some new innovations going on in blockchain, crypto, gaming, 5G, AR, VR, immersive technologies. And then for historical events, we see how this changed consumer patterns, or I guess like shifted different consumer behavior. Examples we saw there were like the SARS epidemic in 2008, the Great Recession, which caused a lot of different ways of economic models and jobs being created. Like I would say, like if you listen to like the founders of Shopify, what really accelerated their company was the Great Recession, finding new ways for the small person to be able to spin up a business and make extra money. And then what we're seeing today with the pandemic, we saw a lot of that historical event caused a lot of us to be doing a lot more Zooms and I guess living in this like so-called metaverse, spending more time digitally and finding different ways to connect because like, connecting with people, that is a constant. That's a constant. I think people want to feel connection, be entertained, things like that. Those are very constant human needs, but we look for what is like the variable and where those shifting to the next, I guess, to the next thing. So I guess to go back to our to how we think about that's like the broader kind of I guess thesis, and then that drives our investment focus. So we look at like the different needs, which is play, spend, and I guess more of a catch-all called lifestyle. At Progression, I focus a lot on gaming and interactive. That's where I spent a lot of my career. But we think that, that is what we think the new social networks could be built in games, and that's what we're seeing. And at in spending and buying and e-commerce enablement, we saw live stream shopping, for example, really taking off, especially with the Gen Z audience. So that's something we look at. And then we think about, all right, how are you going to be online education? How are you thinking about growing, I guess, your credit or your wealth, and how do you think about taking care of your pets or your parents as you age up and they age up? So that's what we call lifestyle. So we think those like I guess verticals is what we focus on, but that's driven by our investment behavior. Maybe those things change, but at least that gives us as a fund. I think Stassi, you said this, what to say no to. People know to come to us for certain things, and we know to do outbound research, for example, on certain areas, because we're not a generalist fund, and we think we find alpha by being pretty specific in our investment focus.
Thanks for that, Mark. I want to bring in Adit and Yash as well. Adit and Yash, similar question to you too as well. When you are thinking about construction of your LPs, are you perhaps first thinking about, hey, this is my area of focus, this is my thesis, this is where I want to be investing, and then think about the LPs, or it's the other way around? How are you approaching it as a fund manager when you're setting out to go out and develop your thesis as well as raise capital?
The first thing is obviously to know our strengths in terms of what our experience has been, and in areas which we understand, and accordingly the fund thesis is built, right? And post that fund thesis is built is where we go out and speak to LPs and look out for LPs and explain them in terms of why we are doing this and what is our track record in doing that, right? So obviously that comes first, and the LPs come second. In terms of LP composition, again, the way we look at it is from a long-term perspective, can this LP will also be coming in our fund 2 or in our fund 3, right? If they're raising, let's say, for fund 1. So again, diversity in the LP base, in the LP composition really helps. We would need the guys who can kind of put in larger checks from family offices. We would also need some founders who are at Series B and Series C, have seen some liquidity event happening, to come on as really value-adding LPs, as well as maybe some money from the traditional family offices as well. So it's really a mix. For Fund 1, typically what I see in India, it's difficult to get institutional capital. Maybe Fund 2 is something which we prepare ourselves to kind of go out and raise large capital from institutional capital like pension funds and other larger LPs. But this is how we kind of overall approach the entire fund thesis, as well as the LP construct?
Just to add to what Adit said, I think for us also it was very similar. That defining what you don't know, and just but with a flexibility to our LPs that if certain trend is catching up, we'd love to go deep and build a thesis, and then add to the things that we look at, versus just simply saying we're going to start looking at something new, right? So our conversation with our LPs has been, okay, we know these 3-4 things really well, and we are looking at these 2 things because things are catching up, whether it's Web3 or towards something else. But the idea always is to go into companies or invest with a view, right? Versus just blindly, versus being reactive investing, if you will. Right? So I don't know if that adds to the discussion.
Got it. Thanks, Yash, for that. Just thinking about this from an LP perspective as well, right? LP constructs in EFMs, right? Like, what does it take to get buy-in, whether you're a thesis focused fund, whether you're a thesis agnostic fund, or multi-vertical fund? What gets institutional capital into the door? Is it first check? Is it multiple checks after? Is it largely corporates which have vested interest towards that particular space, which is, of course, a big contribution to the emergence of EFMs itself? How do more broader spectrums of investors, such as sovereign funds, such as DFIs, such as family offices, think about participation when these funds are yet to prove their mettle? At least from a fund perspective, there might be investors, like the partners of the fund, the GPs of the fund, who might have demonstrated capability either as investors, part of another fund, or as an angel investor, or perhaps demonstrated great capability of scaling up startups by themselves as well, right? How do you choose to back the ability to return capital as an LP, which is beyond, let's say, corporate investors focused on that particular vertical? What are your thoughts on this, Dipankar?
Look, thank you. I think the team's performance is always the first criteria, even if you're looking at a first-time fund. What they have done previously. Has the team worked together? I think that helps. Because I think it's not just a question of one good partner. Because if the partners haven't worked together, eventually you don't know how it's going to turn out, right? The partners might end up fighting, and this is just human nature. But I think they're experienced in the sector they're actually working in, what they have done, delivered, and what their thesis is, and whether they actually have the ability to execute. Which is, I think, say for example, you're looking at doing a company which requires heavy operational inputs, right? Now, if you're a first-time fund and you don't really have the team with the operational expertise, it becomes very hard to see how you'd be able to pull that off. So I think team evaluation in relation to both past experience and what your thesis is. Second, I would also say the sector that you're working in, and what potential it has. And again, I think it comes back that in my own experience, outside the US, it's very hard to see very deep specialization being rewarded, in the sense that institutional investors investing in first-time funds, given it's less common. That said, I think there is a lot of interest in looking at how to get involved, especially in the VC space, because some of the first-time funds end up becoming very good, and then you miss out. So I think there is some thinking, how do we get in and actually build that network for ourselves over a period of time?
I agree with Dipankar. Actually, there is data now that shows that typically first-time funds, which of course in the conventional way of thinking are the riskiest, because as a team or as an institutional fund manager, they may not have actually had a track record and experience, but first-time funds often outperform second or third funds as well. So I think there is merit to getting in early. Much like you would invest in an entrepreneur, first-time fund managers or EFMs are also entrepreneurs. So do they have a good track record of something else that they have done in the past? And then there is a bit of a judgment call that they may have been successful as operators or previously as not the decision makers in some other fund, and can they actually transition well to being investors and make the right calls? Then I think as LPs and EFMs, there is, again, I know it's every dynamic is different. But I've been now an LP in probably 3 or 4 different EFMs, and each one of them we've actually doubled down in subsequent funds, much as the case with Sparrow, but even others where we are starting to actually see distributions. But it takes time. So you have to give it, you have to stay patient, you have to give it time, you have to continue supporting the fund managers as long as they're doing what they said they would. And be prepared to help them, much like you would help any entrepreneur of yours.
Got it. As an institutional LP, right? How do you find that middle ground? How do you look beyond just teams, beyond just the strength of looking at gauging the risk versus rewards at a team level, and thinking about it more from a business perspective as well, right? Like what terms, what structuring, if you're coming in as an anchor LP, are there best practices that you've seen, Chirantan, like across all the funds that you've evaluated, and which are like, I'm sure, like, I think you should give us a number as well, right? Like the number of funds that you've evaluated, but across all these funds, have you seen some elements of the structuring of the investment opportunity for you as an LP, helping you to sort of get past that line in terms of making that investment decision towards coming into these funds?
Sure. And I think, so from a CDC perspective, obviously, as an organization, we've backed, close to 200 odd funds across our geographies, which is South Asia and Africa. But, not more than a decade ago, it was also China. And that's where, CDC at that point of time took a very interesting approach that what we're trying to do now, especially in our markets. I think a very important thing is largely LPs are driven by a programmatic approach, right? So they have mandates and they try to kind of get creative within that. For example, we are, our markets are South Asia and Africa, but I think we're focusing more on the earlier stage in countries that we're seeing as breakout markets within our mandate, namely Egypt, Pakistan, Nigeria. Our focus is more on seed fund managers. And the magic in these markets is that, you find a sharp investor and you have a lot of first mover advantage, you do get returns. And I just wanted to kind of reflect on that point on first time managers. I think there are a couple of benefits that first time managers have. They have a Rolodex that you can use pretty easily. Some of them are entrepreneurs, as Anjali mentioned. But typically the size is smaller. It's, it is easier to return a 30 million fund than a 100 or a 200 million fund. So there are some inherent benefits that you'll see first-time managers in terms of returns. I think the challenge comes in as LPs assessing whether that can happen, over multiple kind of funds. So I think, in India, when I look at our strategy in India, for example, it is to focus on our large existing relationships in venture capital. But we're clear that the next stage of domestic seed GPs is going to emerge. I think that's going to make my job a lot more harder because just to figure out what constitutes the best in what is clearly looking like a period of massive liquidity where everyone's looking good, is going to be hard. So I think, from an LP perspective, there are two things I would think for an emerging fund manager to think about. One is don't be everything to everyone. LPs can make diversification choices. I think just be very, very clear, what's your focus? And by that, I don't mean don't be a generalist. Is your focus, are you an excellent kind of seed investor who just has the best access? Do you think, your sector specialization meets the current kind of zeitgeist of capital flow? What you're seeing in climate VC is exactly that, right? So LPs generally have the ability to generalize and work through a portfolio. I think showing clarity in what you do and don't do is the best thing any fund manager can do for the medium to long term. I mean, I've met fund managers who do not fit our strategy, but are clearly amazing, for lack of a better word. And the thing I do is I refer them to people who are LPs who have that strategy. So that's something very important to find. I think the last thing the second thing I'll say is in terms of we see a lot of fund managers kind of putting forth this thing about value creation. It's a very interesting concept because my first kind of few years as an LP were in private equity, looking at PE fund managers, and there was a lot of unlearning when I moved to the venture capital side. I would say it's less about formalized value creation. I would even consider plain vanilla constant interactions with founders as a plus. How often do you talk? Are you present to founders at late hours? That's the time most founders kind of get done with their business. And it's very hard for a GP to put in their pitch book, but it's it's relatively easy for an LP, who can reference smartly to figure this out. Do you know people in the industry? Do you know a thing or two about the customer base? I think that can put you in a much better position to an LP who's seen a lot of these stories across geographies, and I'd say across vintages. This is turning out to be a very, very good vintage, and I'm very cautiously optimistic about when we're thinking of backing kind of the next generation.
Thanks for that, Chiranta. I actually wanted to jump in with a question here, which I wanted to open to both sides of the audiences, but I wanted the EFMs to go in first on this. How do you think about building your fund in the open versus building a fund, privately? I have seen people here on the panel, Jessica, Yohei, all of you have gone out and built your funds very publicly, doing road shows, building it on Twitter, building it on social media, building an audience, really getting more people to know about your fund, and therefore they're also increasing deal flow and people to get to know the fund and what you guys do. But when you're doing so, has that been a very natural sort of an approach, or has it been a very, you guys thought about it and you wanted to go out, build it? And what are LP's perspectives also? I mean, I'll come to that at a later point, but I want to know how both sides think about this. If Jessica, you want to go first on this? And
sure. I didn't realize that people had the perception that it's very public. That's interesting you said that. But yes, we did have a few events, and I post a lot of things, so I guess that makes sense. But there's a lot of things that are private on the back end, and I think that it could be a good question for the LPs as well, as what do you like to see best practices of how much insights do you want into the fund between the quarterly reports and just the numbers. One thing that's huge on a lot of the funds here is the impact. So, producing things that are actually impacting, women's health or impacting, underserved founders. And also we have a lot of LPs who are first-time LPs that came in for under the minimum. And so, there's a lot of impact that's kind of maybe our focus on reporting as well. So that's just a few of my thoughts. But yeah, we're 506. We're not the public fundraising one. So I think building a brand is nice. It definitely attracts a lot of really great founders as well. So I've kind of watched how the deal flow grew since we started. And I think that's one of the biggest impacts as well.
You make a very good point there, Jessica. Is it less about just brand building and more about educating not just the LP base, also the larger ecosystem, because you guys are going after a very specific market within the larger industry?
Yeah, and I'd say women's health, a lot of things are community focused, and so a lot of the women's health companies do need to build communities as well. And so it benefits the whole ecosystem by building communities of we have our own community of women's health VCs as well. And so I think that's just kind of a natural thing in this world of there's community building, and that's partly how we affect women's health.
Thanks for that. Yohei, what about you?
Yeah, because we do outbound, I always thought that marketing wasn't really important for us, right? We don't need founders to come to us, we're going to them. But this year, I think, I don't really go to conferences and whatnot, but, with the pandemic, Twitter somehow suddenly grew a lot. And I've seen a lot of benefit in terms of being able to network on behalf of our founders. It opens a lot of doors for myself, which means I can open doors for my founders. And of course, it helps deal flow. I've had LPs just directly reach out on Twitter. So as I saw the benefits, I started to lean in harder, and it's continued to kind of come back.
I want to bring in Pearl here as well, because Pearl just finished a conference, and that I'm guessing there was one aspect of branding involved, and the other aspect was also showcasing both your LPs as well as the larger founder base that, hey, this is the fund that we do, this is what we invest in, these are the kind of people that we've got within our network. So it's one way also showcasing the kind of leverage that you have as a fund manager. So how do you approach it, and how did you think about it when you were putting together a conference? Is that one of the themes that we can expect from funds like yours going forward, wherein it's going to be a whole lot of like roadshow in the form of events, conferences, and therefore trying to let everybody else know in the industry that, hey, we're here and this is what we invest in and this is why you got to like take notice of us.
Yeah, no, I think Akash, definitely. The way we think about it is that the next generation of fund managers and funds will be media first. And why that's important, especially in the early stage, is the way we approach the early stage is there are 5 pillars of investing: sourcing the right deals, evaluating quickly, of course, winning the right deals, portfolio management, and exit. I believe that if you invest in the right kind of founders, portfolio management and exit is a function of it. It sort of happens. Excuse me. And that's why, it's very important for us to source the right kind of deals and win the right kind of deals. And that can only happen if you put yourself out there, if you sort of showcase what thesis you have and what value add you bring to the founder outside of just capital. And hence, I think building in public is very important for emerging fund managers, especially in the very early stage, because evaluation is also a very small portion of how you would look at an early stage company.
That's a very good point. And before I bring the LPs in, I actually want to ask the other EFMs on the panel here, like, how do you guys look at all of these other fund managers who are so publicly building, who've got the social media presence, branding? Not to say that you guys don't, but some of them obviously do it better than the others. How do you look at it and say, is there a FOMO that's kind of like involved at some point, saying, should I also be doing this? Is this really my own personal brand? Is this the fund? Is this what I want the fund's brand to be? Or are you guys very happy in your own space, going and doing the things that you've always been doing, perhaps even more quietly than some of the others?
Yeah, so I'd like to take that one, because we have a conversation weekly that says we want to know who their lawyers are, which allow them to basically be so out there in terms of solicitation, because we've taken a fairly conservative approach, which says, we don't want to run afoul of SEC laws. And I think the line is getting very blurred between what is unaccredited investors being pitched and what is appropriate fundraising. So I just have a lot of curiosity about those who are out there and how they are navigating that risk, because again, our lawyers are quite conservative and have really encouraged us, to take a more conservative approach.
I would like to add to the same point which Stasia mentioned. Even in India, SEBI regulations allow us to only, place on a private placement basis, the entire fundraising exercise. So the lawyers are a little bit more on the conservative side in terms of you would not want to cross the line where you are actually soliciting in public directly or indirectly. I think that is one of the reasons why some of the fundraisers are very, very private and not really kind of done in public, even in India, I think. But I agree with Paul as well that there is some way where entire brand needs to get built. Obviously, it could get built through your work, through your references, your network, but some amount of social media awareness also really helps, especially on building it with to get access to better quality deal flow. Maybe there it works better than rather than on the LP side. That's what I personally think.
I would just like to add to that with these conferences, events, or the webinars that we are hosting, we're never asking LPs for capital. It is primarily for us to showcase our thesis and to showcase to the founders what we bring to the table. Whatever LP conversations we have is very, very private. It's mostly done behind closed door, never in public, and not at these events, of course.
Mark and Yash, before I move on and ask the same question to the LPs and understand what is their sentiment regarding this.
No, I think for us it was a function of DNA. Both me and my co-founder we are not very social media savvy. So then we focused our strengths on, So I mean, we draw a lot of inspiration from Benchmark. Like there is Anderson on one side of it. There is Benchmark who doesn't even, the website just says their address. So I think for us, the idea has always been about doing good to your founders, and we are beginning to see that most of our deal flow today comes from our existing portfolio founders because I think my sense it's about what you are comfortable doing. So that's when FOMO kicks in, right? So is that really who you are as a person, right? You can do that on a constant basis. Yeah, that's how I would say.
Yeah, I'd say like I think we're kind of split as a team internally on how vocal we should be about about our fund versus not. I'd say like we like to showcase our founders and portfolio. We're not like out actively fundraising, things like that, and hopefully that will drive LPs towards our way and the right type of founders towards our way. That's how we do it. But I would say that after speaking with like some LPs recently, there's a few that are taking the end reason approach, where it's like I'm a media company first and a VC company, or in a VC second. And I think even a former VC at end reason said that that's their business model. I guess everyone is different. There's no right answer. And for us at Progression, we're trying to figure out what that is. Because I would say like it's the same thing as posting interesting things that you said on like there's like a meme that went around, like post what you posted on Facebook in 2010 or something like that, and like how cringy that would be. So is there something that you're saying out there as a fund that would look, I guess, kind of out of character or like a really bad take in a few years from now? And I think that's why we've been a little bit reserved about being a little too vocal about our fund and what we're doing. But yeah, I mean, I do understand like the importance of it, and some VCs and even at End Reason, they actually want to hire VCs who are very active on Twitter. That's kind of one of the things they look for. So I think it's still like TBD for us.
I had a question for Chitranjan. If I could, this is a good time to ask. Yes.
Yeah, go for it. Yeah.
Of course, go ahead.
Yeah, I just wanted to understand, from an LP side, is the thinking or benchmarks on. So because we've been told earlier that as you build, right, you should think about distribution early, right? Think about giving some capital back in your first fund earlier than you plan to show some DPI and that you can return money as well. So I'm just trying to understand because obviously for our end, a lot of things have changed. Capital is being flowing in, series round valuations are high, so on and so forth. So I'm just trying to understand, are there benchmarks in the industry and have they been changing when you look at new funds?
I guess that question was posted to Chirantan. Do you want to?
Yeah, sure. I think it's a very interesting question, because this DPI versus PVPI kind of dilemma is as old as time, right? Especially for early stage. I would I don't generally kind of be hard on the DPI aspect for VC, but I do see that in when we're in this whole 2021-22 period, having a DPI should be there. But we're investing in venture capital as an asset class, which is typically the most riskiest asset class when you compare some of the other things that we do. We also are debt investors, for example, right, in a large quantity. So we're okay taking higher risk, and we would want to see TVPI even if it takes a bit longer. So I don't think we're that hell-bent on asking our fund managers to show DPI. Again, having said that, like I said, in today's period, if you do get the opportunity, you must, because you're clearly getting it at a much better price. But yes, does that answer that question? It's sort of a non-answer.
I mean, the dilemma for us has been, right? So, for example, there is some liquidity that becomes available at Series B, right? But the company is doing well and you want to obviously hold it, right? So just in order to get that DPI mark early, should you think actively about, okay, I'm going to forego future value just because I need to raise a fund soon, right?
Yeah, and I think about who is coming into that Series B round. If you have a very significant investor coming in, there could be an argument to staying on. This is, and I call this a dilemma when I started, because obviously it also depends on your LP base. If you have a predominant, generalizing here, But if you have a predominant domestic HNI investor base, they may want DPI early, just because they look at it as a pure 10-year product. If you look at a traditional VC LP or any other LP, we are also backing you for fund 2. And we take a much larger kind of time frame to realize. So it may depend on where your investor base is and the proportion of it. But these are some of the discussions you should also look to have with investors, LPACs or things like that. It's quite helpful to think through.
All right, thank you. Thank you. Pankaj and Anjali, do you want to jump in on the same question here and piggyback off of what Chiranthan just mentioned with some additional thoughts?
Yeah, I mean, look, I think to what Chiranthan said, I think for me, it's like you have to make a trade-off and you have to make an assessment. Sometimes you have to take money off the table also. And I mean, given the current valuations, I mean, it again depends on what, trade-offs you're doing versus future value. So, I mean, I also do direct investments, and sometimes we also have that dilemma that should we just take money off the table or continue? And, it depends on, and in some cases we have continued because it makes sense. And in some cases you make a call. Well, this is just a question of, each situation is very unique. It's very difficult to give a general statement on what one should do.
On the flip side, you have the other conversation now of like when companies go public, should you exit or should you hold on to it for longer? And you're starting to see venture capitalists dabbling in that area. So really the options are becoming endless.
I would call it the choices, the key decisioning points are becoming endless. The strategic playbooks don't just always apply. You got to be quick on your feet, nimble, and make those right calls with the right kind of support that helps. But like these kind of forums, we try to utilize the kind of broad-based learnings that a lot of people might have to actually bring that out to the forefront. And thanks Yash for bringing that question up. Quickly moving on to the next conversation because we're short on time. We spoke about balancing acts in terms of TVPI, DPI, but another aspect of balancing is the fact that in the market today, most founders expect quite a lot more from venture capital funds, their investors, their backers as their partners and supporters than they did 5 years back, 10 years back. And for investors as well, the market itself is getting more broad. There are EFMs, there are more funds out there, who are competing for the same deal as well, and things need to move quickly. And post that, you need to sort of deliver on the expectations of the founder and your LPs as well. For first-time fund managers, it's especially difficult because you're working with small funds, potentially smaller management fees, and working with lean teams focused on getting some aspects right. So opening this question up to the larger audience today, like anybody can pick this up. What elements do you try to fix in first? Right? Like when you're first building your organization, what are the most fundamental and important pieces of the puzzle that you sort of bring together before thinking about, expansion, growing, and so on and so forth? What expenses do you meet first up? Anybody who wants to take this? Yash?
Yeah, I can take that. I think for us, we focus a lot on setting processes really, really early, right? Because I came from a large fund in my prior, and I had some exposure on the CFO office side at my last firm. So I knew what was going on in his office to sort of communicate. So even though we were writing small checks, we're super focused on as if we were writing a 2 million check, right? Our investment memo process, our LP reporting process, all of that was going on right from day one, the day we started, right? And it sort of built in a lot of comfort to our LPs that we are thinking about this more from a institutional way, if I may take the liberty of saying that. And so that was one area that we invested a lot of energy in, that debating how something should look like, what kind of communication should go, what should be our take. But second was, given we had some management fee and everything, so just taking a call that for a longest time, both me and my founder will have to do all the hard work, right? So just preparing ourselves for like for example, I'm sure a lot of people on this call have doubled down as lawyers, HRs, accountants for getting audits done. So that mental preparation was also very important, right? So
Got it. Thanks for that. You guys are also doing like another question that we did previously around open, building a fund out in the open, doing events, attracting the right kind of talent, to perhaps going and making sure that your name is sort of visible in the right kind of audiences. Those become important factors in terms of building your own brand, right? So how do you guys think about brand building with on a regular basis with the kind of target audience that you have? Any thoughts on some hacks that you guys might have had? Any sort of frameworks that you adopted to be able to execute this effectively? And any thoughts on this? Maybe Stasia, Mark, what do you guys think about something like this?
I'll just share one of the things we did, which again, I think helped raise our brand and improve our deal flow, was we sponsored a prize, with a partner in the femtech area. HitLab was the name of the consortium we worked with, but it was a modest prize, but we got to select it. So, it's known as the RIA Ventures Innovation Prize. And so again, we had 40 to 50 companies apply each year for that. So we got to see, who's in our space and what they're doing and connect with those entrepreneurs. I do think it also raises the brand in our ecosystem, which is important to us. And we're very focused in women's health. So I think having something like that, again, we're talking, modest amount of dollars, but I think that there's sort of high impact with that. So I would say look for those as a good way to get your name out there and generate some interesting deal flow.
We've been, I guess, like hosting kind of like themed dinners around kind of the areas that we're focusing on, which has been helpful for us. It's been, I would say, low numbers of people turning up in terms of like we keep it capped at like 15 to 20 or something like that, but it's really curated. Everyone gets a chance to kind of meet someone. I think those have been pretty helpful. Also, on a broad base, we have been doing a lot of newsletter, and I think a lot of people here probably do that. I like to put industry insights in our newsletters, and I think that's been getting a lot of I guess corporate interests from our standpoint, because I think a lot of the bigger some of the LPs we're talking to are corporates, and they're looking for something that could, content that could help their corporate development initiatives, and that's actually been a really good thing for us as a fund.
I think you should go on this, given that you also built out pixel based. You want to really talk about how both kind of tied into one another and how that ended up helping your fund in one way or another in some way?
Yeah, the way I learn has always been to build. So I've used that as our content strategy. So last summer, we built out our whole fund CRM using no code. And I live tweeted a lot of that, which got me a lot of kind of no code followers. And this summer, I launched my own 10K NFT collection called Pixel Beast to learn about the space. And now I'm managing a community of VCs and founders who own these NFTs. And that's resulted in a lot of deal flow as well. So it's a little bit of a different take than kind of traditional marketing. It's kind of building as content, but we do that as a venture fund. And my partner Jessica also is simultaneously running a startup and went through Y Combinator. So both of us are, actively building as we invest, which I think gives us a good pulse on kind of, best practices as well as what founders are going through.
Just to add on to that, right? So I was recently looking for an alternative to DocSend, and I noticed that one VC fund called NFX Capital had actually built out an alternative to DocSend and is providing that as a free feature to a whole bunch of founders out there. Wow, that's a $150 sort of per month subscription that now becomes proprietary deal flow for NFX Capital. Very interesting things being built out. Another conversation that we had, I think about a month back, is with EMVC, which is a fintech focused early fund. And they built out a marketplace for fintech only jobs. So any of their portfolio companies or any other funds that are looking to invest in fintech focused companies, they were able to sort of attract the right kind of talent there and provide that out to the entire ecosystem for free as well. So build as sustainable long-term brand building and marketing, is really taking off, and it's beneficial to the whole ecosystem. So wonderful to hear that you're here.
Thanks. And I guess there's actually one more tool that I think people might find helpful. We built another tool. This is a weekend hack called askanything.vc. It is a search engine that only indexes about 200 VC blogs. So if you ever want to search for things like option pools or salary comps, I tend to search there and I push it to my founders and anybody can use it.
Super cool. Really interesting. Would check that out for sure. Thank you.
Some really cool tools being built by fund managers. So this goes to show that the caliber of, the emerging fund managers are not just managing funds today. They're also, in one way or the other, an operator. They're founders themselves. They're also doing a bunch of things on the side. I think that's a great note to bring this first session to a close. And I'm really, really grateful for everybody taking time out, sharing your insights with us very generously. And most importantly, I think we all took away great perspectives from LPs, how they are approaching, fund managers, especially emerging fund managers in newer markets and very specific domains. And on the other side, we had fund managers sharing their insights about how they are going about with their own thesis development and, most importantly, their LP construction. Thanks again, everybody. I want to hand it over to Dhruv here for a minute for him to share some of his closing remarks.
Hi, thank you, Akash, and thank you, Yash, for moderating this. It was a very terrific session and very insightful, very candid. A lot of up and down remarks, but I think these are the kind of sessions we always look out for, which is very candid and very open about. I think so. Thank you so much, everyone, for joining in. And before we close, I would like to it's just like a little announcement. So this was a launch of an EFM club, which we've been working from past, I think, ideating it from past 5 to 6 months with the support of Akash. And now I thought it's an official announcement. Would like to welcome Akash to the team, to 56 team, and Akash will be working with us in building our EFM club globally and working with our larger LP and GP community, which we have built already. So thank you, Akash, for joining us, and thank you everyone for Jessica, Chirantan, Adit, Deepankar, Stasia, Yohei, Mark, and Yash, and of course Anjali just left for the terrific session today.